Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. The markets are having kind of an up and down day today, but mostly down. So I thought maybe we talk about that side of the market for a change. I wanted to talk through or provide maybe a beginner's walkthrough to trading market drops with long put options. An interesting strategy. Not everybody's familiar with options, though, so I want to go at a pace that everybody can follow. But I think this is going to be an interesting discussion within the context of today's markets. So we'll talk about what the strategy is, how much it might make, how much it might lose. Lots to cover, but before we get to any of that, though, let me first of all say hello to everybody who's joining in out there in YouTube. I always like to keep an eye on the chatter that goes back and forth on YouTube. But great to see a lot of familiar people out there. Hello there, Lawrence and Simone, Kelly, Jay Richardson, Will, John, Eva, Richard, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. As I was looking at the chat, I saw a few names that weren't entirely familiar. So if you aren't here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream has concluded, watching those recordings is a great way to see our webcast, but you're also certainly invited to join us in the live stream if you'd like to be here in that audience. This is a Tuesday webcast series, and we kick things off promptly at noon Eastern time. We run about 45 minutes, so that's about what you want to budget. I also want to let everyone know who's here in our live audience that my very good friend Mike Fairborn is going to be hanging out in the chats with you. He's already been active there. I see that. Hey, thanks for being there, Mike. But Mike and I have worked together now for nearly a couple of decades. Mike brings a ton of experience to this, and what he'll be doing is keeping an eye on any questions that come in the chats. And if I can't get to those, he's there to help pick up my slack for me. So thanks for having my back there, Mike. Mike and I would also like to issue an invitation to everybody listening to please follow your favorite Schwab presenters on social media. It's the only place to connect with us in between the live streams. So when the camera's not on, pop over to X, pop over to LinkedIn, and that's where you'll find us. You can find and follow Mike on X at Mike Fairborn CS. You can find and follow me there at Cameron May CS. And you can also follow me on LinkedIn. Just go to linkedin.com/in and then /Cameron May CS. But let's get into this discussion of long put options. It's a bearish strategy. It's a strategy sometimes employed by traders trying to make profits as stocks fall, as counterintuitive as that can be. But of course it carries risk. So let's bear this important risk information in mind. This material is intended for general informational and educational purposes only. Options carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including a loss of principal. And finally, any investment decision you make in your self-directed account is solely your responsibility. Okay, so let's set an agenda for what we're going to discuss today. I'm going to kick things off with just a quick peek at what's going on with the S&P 500. It's been an up and down day. We started things off very weak. We've been recovering a bit, but I want to talk about how a trader might attempt to pursue profits as stocks fall. And I think that this sell-off today has opened sort of a contextual window of opportunity for us to have that discussion. So I want to talk through what a long put contract is, because not everybody's going to be terribly familiar with those. We're going to talk about how they're constructed, how they might be used to leverage downside moves on stocks to potentially profit from those moves. But we also want to go through both the pros and the cons of these strategies. So I'm going to talk through how much they can make, how much they can lose, the general conditions under which they might make or lose money. And we're actually going to be planning and placing an example long put trade today. So I think that's a great idea for a discussion. I think we have a lot ahead of us, so let's get into this. Let's pop over here at the have a look at the S&P 500. Going all the way back to December of 2025, the S&P has really been stuck in what we call a channel or a range, generally falling between 6,800 and 7,000. Really, we teased with closing significantly below 6,800 here and here, but other than that, the closing values of the S&P 500 have all been within that range. But look what's going on today. This is interesting. We started up here, sold off down to lows, intraday lows. We have seen a recovery We've come back up to about that 6,800 level, but it seems like there might be a little bit of an intraday struggle in traders. Are we going to get back up into that channel and possibly go higher? Or is this what was a price floor? Could that be the new price ceiling? And could we continue lower? Let's go forward with that assumption. Assumptions are a big deal. They might not work out. All right. But let's go forward with from the perspective of that trader who thinks that stocks are going to hit a bit of a bumpy road for at least a little while. So how might we make money from that? Because most of us have lots of strategies that we can turn to if stocks are being cooperative with a bullish sentiment. If the stocks are going higher, well, we know we might just buy stocks and let them go up. Buy low, sell high. But how does a trader make money if stocks are falling? Well, here's one of the potential strategies. And it is one of the strategies that I teach in my series of lessons that introduce the concept of options trading. So if you are new to options, I'm going to start things off with a quick suggestion for you. I actually have a series of lessons built just for you, video lessons with examples included, and you can find those on our Trader Talks channel on YouTube. So the first thing I'm going to suggest is that if you're new to this channel, subscribe. Right down below, you can click on the subscribe button. It only takes a second. It doesn't cost anything to do that. But our Trader Talks channel on YouTube, its full name here is Trader Talks Schwab Coaching Webcasts. This is where you can join live streams like this one, but you can also find playlists of previous webcasts, including for my Getting Started with Options series. So for example, if I go to playlists here, we have all these different series. I'm going to skip on down to mine happens to be right down at the bottom. There it is, Getting Started with Options. If I click on View Full Playlist, here's the navigational tip I have for you. We're looking for lessons. So what we'll do is just scroll through these archives. So these are archives of all sorts of topics that I've discussed relating to options trading, but there's a structured series of 10 lessons that are found down below. You just scroll down until the word lesson starts to stand out. There it is. Do you see that? I just spotted it, lesson, lesson, lesson. And you can start right down here at lesson 1, where I lay out the building blocks of options trading, beginning with long calls, but proceeding very quickly to long puts, which is today's discussion. So I think that's a great resource for you. Go check those out. Make sure that you're subscribed. But I want to put us back in the shoes of a trader who sees stocks softening. I don't know if any of you hold that sentiment, but it seems today, I think somebody asked before the webcast started, why are stocks selling off? It may be, of course, we've had an escalation of events in the Middle East and in Iran. And very likely as a result of that, we've seen energy prices spike. Right? I have to qualify that. Do I think it's directly a result of that? Yes, I do, but there are other factors that could be playing a role. Energy prices are sharply spiking. That can have a negative effect on the U.S. economy and on stocks in general. Obviously, that's a story that's still to be told, but we're selling off at the moment. So let's go have a look at a stock. Okay, now I kind of cheated and I went ahead and looked for a stock that maybe a trader might think is going down. Might not go down. But how did I find it? Well, when trading options, there are a few priorities that quite a few options traders will tend to have about the types of stocks that they choose to trade options on. Price per share can play a role. More expensive stocks will tend to have more expensive options, for better or for worse. Liquidity can play a strong role because illiquid stocks tend to have illiquid options. It's harder to get into those. It's harder to get out of them. So more heavily traded stocks might be an emphasis, but also what's happening with the stock chart might be a consideration. So let's look what's going on with Home Depot today. Now, Home Depot is an S&P 500 component company. We can actually go over here if we want to and find a watch list in our gadgets in the left column of the S&P 500 component companies. This is a watch list that's constructed and published by Thinkorswim. So you can just go to watch list in the left column, go to the public watch list from Thinkorswim in alphabetical order down to the S&P 500. But that's where I found Home Depot, looking at the S&P 500 specifically because those companies tend to be among the most liquid in the world. All right. John, you think I just nailed that? What may be moving prices today? Yeah, of course there are going to be variables beyond energy impacts. And And what's expected today doesn't mean that's what's going to happen tomorrow. We have to know that. But let's look at what's going on with Home Depot. Home Depot, much like the S&P over a shorter time frame, the Home Depot's been trading largely within a channel. There was about a month and a half when it was outside the channel, a couple of weeks here, a week there. But for the most part, Home Depot's been trading between 345 and 395 pretty much all year. And right in the middle is the 370 level, which has just been acting as a recent price floor. And we've dropped down below that. And to some traders, when a price floor is broken, they might look, okay, where's the next floor? Where have prices stopped going down and started going up again previously? And that looks like it might be down around that 345 level. You can see that that's been an apparently important turning point on the downside on a number of occasions. So let's say that our trader just thinks there's at least a chance here that with the selling momentum, the selling pressure on Home Depot shares, maybe we're headed on down to that 345 level. Might even happen very quickly. Well, how might we turn that assumption, if it plays out, into actual trading profits? Well, let's set up an example long call option contract. Long put option contract. You can see how cooperative the markets have been with the bulls. I got kind of bullish trade terminology stuck in my brain. We're going with long puts today. All right, so here, let's just break the ice. Let's go right to the trade tab and assume that we're going to trade a long put. And with Home Depot trading pretty close to 365 bucks right now, I'm doing a little bit of rounding. This is the current price of Home Depot. Let's look down at what we call the option chain. And this is kind of like an advertising bulletin board. When you go to the corkboard bulletin boards and somebody's trying to sell, I don't know, a 1994 Ford pickup truck, and they have little pull-off tabs so you can give them a call using the number on the pull-off tab. That's kind of what this is. That's the way I think about it. It's an advertising board where we can purchase options contracts. And there are some contracts that just run for a few days, like this series of 3-day contracts for Home Depot that run through the 6th of March of 2026. Or we could get into contracts that go all the way out for many years. I should say a few years. 1,018 days in this case, out to the 15th of December of 2028. So now, if this is your very first time seeing an option chain, you're already starting to understand what these numbers represent. So what I want to look at here, let's go out, and today we're going to be trading a contract that runs through the 17th of April. It's a 45-day contract. So I'm going to open that up, and I'm immediately going to focus our attention on this column right in the middle. It's called its strike price. We're going to strike a deal with another market participant out there, another trader. We're going to get into a contract with another trader out there. All right, so here's the deal we're going to strike. We are going to buy a 300 with the stock again trading near 365. Let's go to the $365 strike. We're going to strike a deal to maybe trade shares of Home Depot for 365 bucks. So here's going to be our example trade today. Let's make this bold. I just think it makes it a little bit easier for everybody to see. Our example trade is what's known as a long put. That just means long is a term that we use in trading terminology when we buy something to enter the trade. If I buy a stock, I say I'm long that stock. If I buy a put option, I say I'm long that put option. So we're going to buy the 17th of April, $365 put. Let me get my cursor out of the way so you can see what we're doing. And right now, if we look over here to the right, we can see two columns, bid and ask. These are basically showing us how much the buyers are paying to buy puts and how much the sellers are receiving when they sell puts generally. So 365 looks like we're somewhere between 1410, 1480. Let's kind of split the difference, and let's say that we're going to spend, we don't know if and until this order fills, about $14.50. Okay. So it's kind of easy for me with all the experience I have with this to explain, to just say, hey, here's what we're doing. We're buying a 17th of April 365 put, $14.50. What in the heck is that? Well, it's actually a contract with very specific details. And I know when you start to talk to me about a contract, I start to sweat a little bit. If we're talking about a home purchase contract, if we're talking about a contract to buy a car, my antenna go up and I'm on high alert because I realize this is serious business. And when trading options, it's also a serious business. It's the entering into and exiting from contracts with other market participants. So our contract here is going to stand in for contracts in general, but there are some common threads running through all options contracts. And we're going to be looking at this from the perspective of buying options today. So number one, when buying a put, and I'll be specific here, a put contract details. When buying a put, it gives us the right to sell 100 shares of the stock that we're trading put options on. So you'll notice right here it says 100. That's just a reminder that these are what are known as standard contracts. A standard contract is for the potential exchange of 100 shares of stock. There are some non-traditional contracts, and you'll see those displayed in other quantities, but they are unusual. They're less common. Vast majority of options contracts represent 100 shares. So with a put, we have the right to sell 100 shares. Now, a second specific contract detail is that is for only for a specified period of time. There is a specified time frame for this trade, and we know that with this one. When does this contract end? 17th of April. It's just displayed right there. But there's a specific time frame, also known as the expiration date. Now, number three, we have the right to exchange shares for a fixed price. This is known as the strike price. And in this case, that's our, what did we say, $365. Now, to enter into this contract, we paid some money, and that's what the $14.50 represents. We're paying $14.50 for the right to sell 100 shares of Home Depot for the next 45 days at any time within the next 45 days for $365. That's our deal. And for that, we paid a premium, in this case, of $14.50 to secure that right to sell those shares, $365 through the 17th of April. Now, finally, we need to be aware that this contract is what's called transferable. Meaning, I remember when I first started thinking about trading options, long before I actually placed an option, I wanted to be absolutely certain. So when I get into this thing, am I stuck in it for the next 45 days, or is there a chance I could get out of it before the end of 45 days? Yes, this contract is transferable. In other words, if we bought this put, we own that contract, we have the option to sell that contract for someone else for prevailing market values at that time, right? Just know that we're not obligated to stick with this trade all the way through the 45-day contract period. All right, so those are the details. So I've kind of outlined those. Let's just revisit those within the context of what we're doing here today. So if I spend $14.50, that secures the right to sell 100 shares of stock for $365. So it's $14.50 per share. What's actually being spent here is $1,450. That's $14.50 per share times 100 shares means the total cost of this option, not including commissions. Commissions do play a role, although not nearly the role that they played in previous decades. We're spending $1,450 for the right to be able to sell 100 shares of Home Depot at any time between now and the 17th of April for $365 per share. So that's the contract. How do we make money from that? look at the stock. It's actually cooperating nicely. We're actually right at $365 right now. Well, let's talk about how much we can make, how much we can lose on this deal. Where might there be a break-even point on this trade if we were to just stick with it all the way through the 17th of April? How can this turn out? And before we're done today, let's make sure that we actually place a trade. All right. So how does this trade actually make money? Well, if we spend the $1,450 here, we know, okay, so now through the 17th of April, we have the contractual right to sell shares for $365 per share. It's not a huge value to us right now, is it? Congratulations, Cameron. You have the right to sell shares for exactly how much they're worth right now. It's not that value that this trader is interested in. It's the value they think they're going to be able to get should the stock price fall. So how about we do this? Let's get in our time machine and let's go forward a few days, maybe a week from now. Let's say that all of this selling momentum that we've been seeing over the last couple of weeks, it persists and we continue to sell. Another, what is that? Another $20 to the downside. How long did it take us to travel $20 to where we are right now? That took a few days. This was a $385 stock about a week ago. It's a $265 stock today. A week or two from now, could it be a $345 stock? It certainly could. Am I guaranteeing that's exactly what's going to happen? Nope. But what if our stock falls down here? Let's just use March 20th as a convenient reference point. Let's say on March 20th, we're down at $345. And I revisit the details of my contract. Wait a minute. I have the right to sell this $345 stock to someone else for $365. That's a $20 premium or benefit above that future expected price of the stock. So if I have a $20 advantage, how much did I pay for that advantage? I paid $14.50. At that moment, I would have at least a $5.50 profit. Does that make sense? It's exactly the details of the contract that have delivered this outcome to us. If the stock's only worth $345, but we have the contractual right to sell it for $365, that is a $20 contract at minimum. Now, Dragon Rider market has definitely recovered since this morning. Absolutely true. And so we need to discuss the other side of this trade, which is if stocks go up instead of going down, it's going to lose money almost certainly, if that's what's happened. But I like to talk about the fun part first, then we'll talk about the necessary part. Okay? But yeah, that's how puts make money. And by the way, why do we call them puts? Well, we call them options because we have the option to sell the stock at a specific price. We are not contractually obligated to sell the stock. We have the right to, but not the obligation to. All right? Now, the next thing is, why do we call it a put option? Well, because if you think about it this way, we have the right to sort of stuff our shares. You know, let's say we go out and we buy 100 shares at $345, and then we exercise the terms of our contract. We're able to sell those. We can contractually enforce the right to sell those shares for $365, put those shares into someone else's account, and gain compensation from them selling those shares to them for $365. We're putting those shares to the other person. Yeah, Kelly says the stock gets put to you, or in this case, we'd be putting the shares to someone else, right? We have the right to sell those shares, put them into someone else's account. So that's kind of what I think of when I try to think of what does the terminology mean. We know now it's known as a put option contract. There we go. All right, now here's the little hidden magic of the trade, though. If the stock is down here at $345 on March 20th, it will be worth at least $20, but almost certainly more than $20. When you might think, why would it be worth more than $20? We have the right to sell a stock for $20 more than it's worth. That's a $20 advantage. Isn't that a $20 contract? No, because That's what we would call the intrinsic value of the contract, that discount, right? We can buy the stock for, well, not the discount, the premium that we can sell the stock for. There's $20 of value there, but there's still a month for that value to grow. That month is going to be valuable if we decide to sell our contract to someone else. Hey, we have a stock that's been falling and falling and falling. As a matter of fact, it's fallen $20 over just the last couple of weeks. How far could it fall in the next 4 weeks? Well, it could fall even further. That potential adds additional value to this contract, which still hasn't run its course. Simone says that's the time value of the contract. Exactly right. Yep. So our contract might actually be worth $22 or $23 or $24. Wouldn't it be nice if we just had a calculator to tell us how much it might be worth? We actually do. Yep. Let's go back to our trade tab. And I'm going to go to our strike price here, that 365 contract. And I'm going to change these columns over here. You'll notice that these extra columns over here, they're showing us how much volume there has been, how many of these contracts have traded at the 365 strike today, and how many total open contracts there are at the moment. So 7 contracts have traded today, contributing to 445 open contracts. But let's change these columns. I'm going to come up here to where notice the volume and open interest. Those are our columns right up here. There's a menu of columns that we can choose from. And I want to switch this to a column known as theoretical price. Because when we buy something with options, well, when we buy a stock, we know if the stock goes up $1, we make $1. That's the way stocks work. When we buy an option, it doesn't quite work that way, because price is having an impact, the stock price is having an impact, but also time is having an impact. So it's nice to have a calculator to tell us how much we might make or lose on that contract. And that's where the Theo Price calculator, it calculates theoretical future values of options. So here's our calculator. And then if you try to think about your, just imagine a little handheld calculator. It has a little digital display at the top. This column is basically that digital display, all right? So let's change some assumptions about our trade. Let's click on where it says Theo Price. And let's say that by March 20th, we think the stock is likely to fall $20. So let's put in minus $20 by March 20th. And now as we enter those variables, we can look in this column that says Theo Price, and it will project for us a future expected value of that option. So if we bought that option for around $14 and the stock falls $20 over the next however many days it is until the 20th of March, 17 days, the expected future value would actually be about $23. Now that really highlights. Now, so we know it has a $20 value because of the discount we're getting, well, the right that we have to sell the stock at a higher price than it's worth. But it also has some value because there's still some time left on the contract that could be attractive to a buyer of that contract that we're then selling to. Now, another insight this gives us is the incredible leverage of an option. This is potentially advantageous, potentially very risky. Leverage can work in either direction. But let me do some quick math here. If our stock falls $20, but it started off at $365 per share, a $20 drop on a $365 stock is only about 5.5% drop on Home Depot. It's gone from 365 to 345, not a very big move in percentage terms. However, what's been the move in the value of our option? Well, if we buy that option right now, it looks like it's even less than what we originally calculated. We might be able to buy that option for about $13.50 at the moment. Let's put that in here. And if it then fell to 345, that contract would be expected to be worth around $23. That's nearly a $10 increase. Let's call it $9. Going from 13 and change to 22 and change. That's a $9 increase on a $13.50 investment. Well, how much leverage is that? 9 divided by 13.5. That's a 67% change in the value of that contract in a few weeks from a 5% move in the stock. That is leverage. Now that's fun leverage to discuss. We've been talking all about how this stock might make money. So I think you're getting the point that if Home Depot goes down, this stock or this long put option can make significant money. And by the way, is there any real line in the sand that says that Home Depot can't continue to fall below 345? If we buy and hold this contract, and if stock really starts to fall hard, could it fall further than that? Could it go to 340 or 330 or 320 or 310? Yep. The further the stock falls, the more the put option contract owner makes in profits, because they have the contractual right to sell shares for 365 at any time for the next, was it 37 days? What was the length there? 45 days on this contract. Eva says there is no line in the sand. Well, there is at the bottom of the ocean, right? If the stock goes to zero, that's where it stops. Can't go any lower. So for our put option, that's the most money we can make, is if Home Depot were to go all the way to zero in the next 45 days. Is it likely that every Home Depot store on the planet closes its doors? It's delisted, no longer trading 45 days from now? Not likely. Is it within the realm of possibility? I suppose it is. It's not terribly likely at all. Okay, so that's fun. The further down the stock falls, the more this trader can make. But they also have significant exposure to risk. And you may have been watching that play out. What did we originally propose we could buy this option for? $14.50. Then the price changed as I was talking. It's now only $13.50-ish. That's about a dollar change. Holy cow. A $1 change on a $14.50 investment this thing is already down 7% from the start of this discussion in a few minutes. Yep. Options can move. They can move up in value. They can move down in value. What has happened to the price of Home Depot since we started talking? Despite our hypothetical investors' conviction that it should be going down, it can go up as well. That's what's been happening. We've been seeing a little bit of a rally, not much. We've gone up maybe $1 on the stock, but that's having an impact on the value of the option. It's not good. This is a bearish trade that benefits if the stock falls. If the stock rises, we can lose money. How much can we lose? We can lose it all. Yep. We have right now, theoretically, the right to, I say theoretically because we haven't actually placed a trade yet, but hypothetically, we have the right to buy or sell shares for $365. And if those shares go up in value, do we want to undersell the markets? Is it an advantage to be able to sell the stock for less than it's worth? No, it's not. We hope that, it's not going the right direction. We need to see this course correct and go down, because if we get to the end or at the end of our time frame, end of our contract, and the stock is above 365, our contract has this much value. Zero value, because we have the right to sell the stock for less than it's worth, not good, and there's no remaining chance for the stock to course correct. We've run out of time. So, yeah, we need to be aware when trading options, we can make money. When we buy a put, I think you can see we could make a lot of money, but we can also lose money. How much can we lose? Bottom line, the amount that we've invested, this much is at risk. It doesn't mean that we have to sit idly by and just let it all evaporate, but that's possible. If we just sit there and watch a stock rise or stay above 365, we let it get all the way to the end of the contract period. If it crosses the finish line, expiration above 365, and trade's over, we lost it all. So maybe the trader might want to have a plan if their premise is they think the stock is going to go down, and yet a few days from now, maybe a week or two, if we've been patient, the stock just isn't going down, if it's working its way higher, maybe that trader wants to pull the plug on this idea, move on to another one. Try to stem the bleeding. But to the point of expiration, Kelly says, game over. That's right. Yeah. I do want to talk about this. Even if the trade is going well, let's say that our trader's initial plan was, hey, if the stock drops down here to 345 pretty quickly, I'll just grab those profits. It looked like it was about 67%-ish as a potential if we got down to that price level in the anticipated time frame. 67% is a heck of a profit. But maybe they get there and the trade is going so well. Can Be Done says, are you worried about the elevated VIX? That's a good question. And it does relate to this discussion. It's going a little bit further afield than I wanted to discuss today. But if you want a good discussion of volatility, which is what the VIX is, I had one in yesterday's webcast. So you may want to go check out my webcast from yesterday. Anyway, let's just say that our trader is kind of feeling, ooh, I'm feeling confident now. The stock's going the way I thought it would, and I still have, let me check my clock, 17 days into this 45-day trade, still got 28 days to go. How about we just hang on, see what happens? Let's say the stock continues to go down. So, oh, this is looking good. Maybe it just goes, it's a great trade. It's down here at 330 bucks at expiration, and they think, awesome. But they forget to sell their contract. What happens then? Well, for 45 days, we've had the right to sell shares for 365. We no longer have that right. At the moment we cross the expiration finish line, we have an obligation to sell the stock at 365. Yep. When an option is what we call in the money at expiration, and in this case, if we have the right to sell shares for 365 that are only worth $330, we would say that that contract is $35 in the money. In other words, there is intrinsic value in this contract. At expiration, those are all exercised. Now, if we roll the clock back a couple of decades ago, they would have just been allowed to expire worthless, which isn't great, lose $35 per share of value. But nowadays, if that contract is even 1 penny in the money, or in this case, if the stock is $1 penny below $365 at expiration, it's exercised. So here's what that translates to for us as the owner of that contract. Shares are sold on our behalf, whether we own them or not. If we owned shares, those shares are sold for $365. If we don't own shares, shares are borrowed on our behalf and sold for 365 bucks, and we now have what's called a short stock position that has, let me throw this out there, unlimited risk potential. If you don't know what short selling stock is, better get acquainted with it if the plan is to allow long put contracts to go all the way to expiration. Leslie says, got here late. Welcome to the show. Did you talk about whether the dividend payment that's coming up? There is a fairly sizable dividend payment of $2. How that might influence the stock price? Dividend payments reduce stock price. They cause the stock price to go down. Does that help or hurt our long put here? We want the stock to go down in price. So it's a good question. There's a $2 and change dividend that's coming up. Yep, before expiration. So that's how it would impact this option. What it would do is it would just push price lower, which benefits our contract. Good question. Thank you. Anyway, so now that we know how much we can make on our contract, we know how much we can lose on our contract. What we should know is that we're not required, as I've mentioned, to hold this all the way to expiration. So maybe what the trader does is, how about we do this? Let's say that we projected about a 67% profit potential if we fell down to that $345 price floor. Let's say that we're okay with even making a 50% profit, right? Let's go see how much this is trading for right now. 365. Looks like we're still in this neighborhood. 1350. Might have to pay more than that. Might have to pay up to $14. So what if we were able to get a 50% profit on that? If we were in for about 14-ish, if we can sell for around $21, that would be about a 50% profit. So let's make that this trade's objective. On the other hand, if the stock starts to misbehave, if it's not going down, if it's just kind of drifting sideways, where it's running out of time, or if the stock is going up, how about we pull the plug at, let's say, just as an example, a 30% loss. So let's run some quick math. Let's say we're able to get in for, I'm going to say we get in for 370. Okay, seems to be close to what current prices are. Let's do some quick calculations here. Or not 370, 1370. If we multiply that by 1.5, let's say that our target is to get out at $20.55. On the other hand, if we pay 1370 and we lose 30%, let's multiply by 0.7. Let's say that our trader's pulling the plug. Shall I do a little bit of rounding, call that 955. So 2055, if our investment is increasing in value, we'll take our profits. 955, if our investment is losing value, we'll just try to cut our losses there. Let's go place this trade. Here's how the trade might be placed. Let's go to our puts. I'm going to right click on the ask price to create a buy order. And I'm going to put in a custom buy order with what's known as an OCO bracket. One sell order cancels the other sell order. One sell order to take a profit, one sell order to take a loss. There we go. So this is going to be our trade. How about we just do one contract? Let's link all of these together, the buy order and the sell orders. And let's just do one example contract. Let's say that we're willing to spend $13.70. We'll put that in as our limit price. We're going to put in a profit limit order, good till canceled, to get us out at $20.55. That would be, if we're able to accomplish a 50% profit, that'd be great. We'll just take our profits there. Or if we fall by 30% through just the passage of time, wasting our contract value, or if the stock's moving in the wrong direction, either one of those things can be negative for this trade. Let's make that good till canceled. That's going to be our example trade. Okay, Chuck, yeah, that's a good question. There's not going to be time for me to address that, so my apologies, but let me click confirm and send here. We're going to buy one example Home Depot, 17th of April, 365 put, trying to get it for $13.70 or less. Might not fill. We'll see. If we get it, we'll sell to take profits up $6.85, or we'll sell and take losses if we happen to fall $4.15 or more. As with other types of stops, it's not a guarantee that we'll exit at exactly $9.55. It could be less. This is just going to be our trigger price. Now, there is a commission to get into or out of this trade on a contract. It's 65 cents to get in, 65 cents to get out. That's not per share. It's just 65 cents. And I'm going to send that order off. And we're in for $13.60. Great. All right. But guys, this has been my introduction. This is sort of the beginner walkthrough for how a trader might profit from falling stock values from a market drop. And that is one of those strategies is buying a long put. So we've talked through what that put contract is, how it might make or lose money. We've even placed an example trade. Obviously, there's more that you might want to learn about trading options. That's why I put together that structured series of videos for you. So if you want to see that again, first of all, big suggestion, if you're new to the channel, make sure that you're subscribed to the channel. Go down and click on the subscribe button. It only takes a second. It doesn't cost anything. But our YouTube channel is called Trader Talks Schwab Coaching Webcasts. And you can join our live streams right here, or you can find playlists of previous webcasts by clicking on playlists. And for my Getting Started with Options series, those playlists are all the way down at the bottom. There's my series, Getting Started with Options. But to find the series of lessons that I put together for you, click on View Full Playlist, and then just scroll until you see the word lesson start to appear on your screen. It'll take you a couple of seconds. There it is, lesson 6 of 10, 5 of 10. I would suggest start at lesson 1 of 10 if you're brand new to options trading. Dragon Rider, yes, this webcast is scheduled to be posted. Should happen quickly unless there's some sort of a technical glitch or a hiccup. Anyway, but guys, time for me to let you go. But another suggestion for you is to follow your favorite Schwab presenters on social media. You can find and follow Mike Fairborn and me on X. You can find Mike there. Give him a follow at Mike Fairborn CS. You can find and follow me on X at Cameron May CS. I'm very active on social media. I just posted on X today, and if you reply to one of my posts, I try to reply right back to you. So, for example, I just posted, "What do you think is going to happen with gold and silver from here?" With silver down about 8% as of earlier today. Wider audience out there in YouTube gets a boost in the YouTube algorithm. But wider audience out there in YouTube gets a boost in the YouTube algorithm. But I'll look for you in a future webcast. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish the very best of luck. Happy trading. Bye-bye.